questions, please ask them. Today, I thought I'd talk about strike and expiration selection. It's always a question and that comes up when I'm mentoring or just talk to people about positions. And it's pretty confusing because there's no hard and fast rule about it. I did search on the internet, you know, Google's our friend, to see what other people said about it. Some people have hard and fast rules that this is what they do, but my experience is that things change as markets change and rules change. There's no such thing as rules. We have disciplines that may be rules, but when it comes to strategies, these are guidelines. And so this is what I'm going to talk about today, strike and expiration selection. It turns out to be much more involved than I thought it would be. Normally I go past 2, but I have positions, and today the markets are down, the S&P 13.5. And so I'll probably, I think I may want to put some stuff on. I've been marginally invested as a premium seller, and this seems like a good time to for me to stick the toe back in a bit because volatility is up. So remember, don't always do as I say, and one thing I would like to point, and we'll do the caveats as we move forward. Okay, so who am I? I'm Frank Fahey. I have, over 25 years experience trading options. I first went down on the floor in 1984. I did have a 1.5-year hiatus there where I was regional manager for Aero Electronics, a big electronics distributor. And prior to that, I went to college forever, and I had worked for IBM, and for the old-time techies, I worked for digital equipment. So I've seen lots of things. I was in the pits for the crash of '87. I saw the explosion, the dot-com explosion. I've done lots of things. I was on the trading floor, actually at my desk on 9/11. So I've been through an awful lot. I've seen stocks go from 110 down to 40, up to 135, back to 110 in the same day. I mean, and stood in the pit and traded it. I was trading Rockwell when the Challenger exploded. So I've been in the fire more than once. Okay, so one of my favorite sayings, actually it was my dad's favorite saying, was chance favors only the prepared mind. Now I thought my dad was a genius. I lived by it until I realized, looking it up in the age of the internet, once again Google being your friend, is that Louis Pasteur said it. And the entire quote was, in matters of observation, chance favors only the prepared mind. And it's very true. And one thing, the addition of in matters of observation tells me is that it is important to observe and to know what's going on. So what is the prepared mind? It's common to achievers across many high-risk professions. That can be fighter pilots, regular pilots, first responders, firemen, forest fire people. It's something that people have, and it is common to traders too. I mean, because it's a high-risk profession. We're risking capital instead of our lives. So one thing is the prepared mind constantly hones and expands their knowledge base. In our case, it's our options or trading knowledge base. In the case of the pilot who landed the airplane in the East River, it was his flying knowledge base. It was how to respond to an emergency knowledge base. I'm sure he had gone through how to land a large airliner in a body of water many, many times. And so what this person does, what the prepared mind does, is it envisions opportunities where others see risk. So, you know, what was the guy's name? I think Sully. They said, you know, he envisioned an opportunity where anybody else would have said, hey, we can't do anything. He realized he couldn't land at the Newark airport. He had to land in water. Okay? So what it is, it's an ability to recognize, to decipher, and act across a complex set of conditions. And one of the ways we all do this, and successful traders do it, successful prepared minds do it, is by having the ability to reduce things to the lowest common denominator and filter out the excess extraneous noise. So as a trader, what do? I challenge and I test trading strategies. The goal is to make an informed, reasoned decision. When everything hits the fan and when there's trouble, I don't want to have to react emotionally. I don't want to react in panic. I want to say, hey, the engines are out. Where am I going to land this position? And that happens. So what we do is, you have to do is visualize alternate futures. Alternate realities is what some people might say. Okay? So today, I forgot about this one. Insanity. I'm sure many of you know this. It's a favorite of mine. It's doing the same thing over and over again, expecting different results. So that's why I do the what ifs, because I will do this after the fact, saying, what did I do wrong? What could I have done different? If we have enough time at the end of our session today, and I may hop in and do it, is I'll go over a Whirlpool position I put on Thursday that was a bad position. And it was basically not due to sloth, but I could have looked at it longer, harder, deeper. And so what happens is I learned something from it, and we'll talk about it as we move forward. Okay. Hypothetical performance disclaimer. And this is a disclaimer for anything I say about real positions or real stocks. Many people use stock ABC, stock XYZ. That's because it's a stock you can't trade. I prefer to use real stocks. Now, one thing to remember, and this is the truth, is past performance is no indication of future behavior. I mean, or future results. It just isn't. So if you see me do a position with Whirlpool, if I make a presentation with Spider, SPX, anything else, I am doing it for teaching purposes only. What I'm doing is we're starting at a starting point and we're going, what if, what if, what if? What am I going to do? What if I look at it like this? It's looking at things from a different perspective. It's how does Frank, who is an active trader, look at things? What is the process he goes through? So if you have any questions and want to add to it, I'd appreciate it, because one of the important things for us as traders is to have a community where we can ask questions. Remember, there's no such thing as a dumb question. My head gets turned around where I go, okay, I'm confused. I mean, I'll sit here and after nearly 30 years of trading, I'll go, okay, and trading options is, now if I have a negative theta, does that mean I get money or I pay money to owe the position? I mean, little things like that. I'll get confused, I'll get turned around, and I'll know I'm turned around. The other thing that I'd like to say is, if it's too good to be true, if you think you've found a surefire way to make money, check again, talk to somebody, because quite frankly, even with the great tools OptionVue provides and with the mentoring you may or may not have in your experience, we are not going to beat the Goldman Sachs, the Timberhill, any of the big hedge funds, BlackRock's computers to finding it, okay? Our discipline will allow us to make some money. We're much like the remora that swim in and out of the mouths of sharks, getting bits of food, more than enough to live on, but we have to be disciplined to do it. So that's where we are there. My performance disclaimer. So everything is hypothetical is hypothetical. It's not real. And one of the things that's a characteristic of unsuccessful traders, an inability for them when looking at the future to discern between hypothetical and reality. Quite often what they see is what should be imagined or hypothetical, they see as real. And so keep that in mind. Okay, now I'll figure here's the next button. Okay, factors in strike and expiration selection. As I said before, there's no hard and fast rule to this. Okay, but here's the things that all the different factors that figure into making that decision. Number one, what is the underlying? Is it an equity? Is it an ETF? Is it an index? Is it a future? Okay, each of these have different characteristics. And different characteristics as far as historical volatility, implied volatility, margin requirements, types of options that they are. Is this a European option or an American option? Is there a dividend or isn't there a dividend? These are things that are very important to know. And that's part of the prepared mind. So what I'll often do in OptionVue is there is a section there that's called Notes. And when I'm trading equities, if I'm trading an equity, I'll look up the dividend, the ex-dividend date, and the earnings date, and I write it in Notes because I have to know where I am. In addition, I have to have a goal, which is always, do I want to make money? Now, one thing I would like to say is goals should be reduced to dollar rate of return. Dollar risk, and I shouldn't say rate of return, dollar return, dollar risk. Too often I see people looking at percentage. I want 18%. Well, 18% can be $18, $1,800, or $18,000. Percentages mask the true risk. We are risking dollars. Our reward is in dollars. If you take care of the dollars, rate of return takes care of itself. Okay? Now, somebody said, do I put together a checklist, and does each factor have a weighting to arrive at a score? No. It's things I consider. At times I go through it. After 25 years, I'll go, on the what if. I don't wait. For example, no, I don't wait. One thing I don't have here is one thing I do, and as we go through, I did not emphasize the importance of understanding the Greeks and what the Greeks tell us, okay? Whether it's gamma or delta, volatility. Every underlying has its own implied volatility. It behooves you to understand implied volatility, the effect that earnings have upon implied volatility, the effect that the type of market, whether it's bullish, bearish, or just sideways moving, has upon implied volatility, and the effect that it has on commodities versus equities. And that's, further down the line. But get to understand implied volatility. The better you understand it and the cycles of implied volatility in the life of an option, the better trader you will be. It's a given. But the Greeks allow us to reduce things to the lowest common denominator. Quite frankly, when I'm looking at options, and if I had a checklist and then a weighting, okay, and a score, quite frankly, that would take way too long and would slow me down way too much. Quite frankly, I'm a little too ADD to go through that process. I mean, it's something I go through, what if, and depending on the stock or the underlying, that checklist changes because extraneous noise is sometimes not on one thing, it's not extraneous noise on another. So, okay, it's strike selection is also dependent upon the strategy. It's a vertical, covered calls, butterfly. Those are just three that I brought up, okay? And there's many other strategies, okay? Market sentiment, is it bullish, bearish, or neutral, okay? One thing I'd like to say about market sentiment is there's two ways that we can look at it. On any, and I'll take half a step back. On any option strategy, I look at it based on movement in the price of the stock, okay, movement in implied volatility, and time. So from the option standpoint, movement in price in the Greeks, okay, movement in price and the effect that has upon a strategy is defined by A, delta, which is movement in the price of the underlying, B, gamma, how fast the price changes, okay? In addition, we have implied volatility. That is measured by Vega, okay? Then we have time, and any strategy has a number which is theta, and that's time. So we have movement in the price of the underlying, which is delta and gamma, movement in volatility, which is Vega, and movement in time, which is theta. And these are all dollar exposures. They are not rate of return exposures. Please remember, look at dollar risk, look at dollar reward. The better you get at it, the better trader you will become. Okay? So I will look at things from a time window too. When do my market sentiment, or when do I think something will happen? And that time window could be days, and that's realized or accepted by the exchanges. We have weeklies now, okay? So that's a more immediate risk reward. We have weeks, which was once again weeklies, and then there's months. We have different expiration months. Okay, and some of them are what we call earning months. They're always 2 months in a row. At any given time, you always have the front 2 months. But the Greeks have different characteristics depending on how many days to expiration there are. So this is very important. My checklist, and that was a good question. Okay. I'm going to take half a step back. Somebody just said they are having difficulty hearing me. They can barely hear me. How well do you hear me? Is anybody else having difficulty hearing me? Okay. The problem is definitely with your connection, not with my connection. Okay? So, and thanks for asking, because this is a new presentation system. We usually use WebEx. This is a new one for us. And I'd be very interested, and I know Jeremy, our tech guy, our tech god, would be very interested too in any problems or concerns you have about this. So the time window is very important. But an expiration, the Greeks, for any option, are different if we looked at the 100 call in Caterpillar, the March call, the April call, the June call, the October call are all going to have different characteristics, okay, based on how the option reacts to change in price, change in implied volatility, and change in time. Another thing, and gosh, I'll emphasize it again, risk reward. Ha! That's sort of fun. I've never used that tool before. But dollar risk reward, that's what we trade for. That's the most important thing up there. It's knowledge. You know where you are over time. All the Greeks. But what is my, am I up money? Am I down money? And where am I up money and down money? Because on a position, and I'm going back. There's been times where I've been losing money, and it's what I would call fake money, an explosion in volatility, and I'm still in the middle of my risk graph. And I've known people that will take it off. I'll sit there and I wait, because one of my market beliefs are all options go to zero or parity. Okay, another thing that's very important in factors in strike and expiration selection is liquidity. And by liquidity, I mean option volume and option interest. I do not want to trade something where there's no volume. The less the volume, the wider the markets, the harder it is to get in at a fair price and out at a fair price. When I was a market maker and stood in the pits, we would have 30 stocks in a pit, of which maybe only 4 traded. And you might have 15 stocks or 15 traders in the pit, and 6 of us would, gosh, I'd only trade 3 or 4, but there'd be another 2 or 3 or 4 that I would trade just because somebody had to trade them. And 2 or 3 of us would trade them, and we call it trading by appointment. And there's nothing worse, and this happened to me as a market maker, than having a position that is making money that you can't get out of because there is nobody to take the opposite or closing side of the trade. Nothing worse. So one thing I always look at is option volume and open interest. Any questions yet? Somebody just asked me, do I focus on specific Greeks? Quite frankly, I focus on all the Greeks right now. I can tell you what the Greeks are on any position I have, and probably any position, gosh, over the past 30 years, I've never been able, I've always known what my position is, ballpark. Even in fast markets with computers down, I could keep a running total in my head of whether I was short gamma, long gamma. I could ballpark my delta within a couple hundred. And this was back in the days when I had positions with 10, 20,000 options, 250,000 shares or more. I mean, significant positions, and trading 3,000 or 4,000 options in a day. I might slow down, but I mean, when I first started out, I had a run at the beginning of the day, and that's it. Everything else I did by hand, and it was just a number of contracts reduced to stock equivalencies. So that's what's going on. The only thing I don't keep an eye on, and somebody brought it up, is row, row, row your boat. Row is our exposure to a 1% move in the interest rate used to calculate the options price. When I first started trading, row was very important to know because the broker call rate was 14%. Okay, and on my short stock side, I got 80% of broker call, which was 11.2%, and I paid 1% over. So my range on interest that I borrowed or interest I lent at was 11.2 to 15%. Might have been 15.5%. And there were times when interest rates could move significantly. So right now, if you have a positive row, quite frankly, with interest rates near zero, you have no exposure. Now, if you have negative row, you have some exposure, but quite frankly, that doesn't happen too much. The further out a option position is, the higher your row is. And that's a basic fact. Okay? So, okay. So here's another question. If a Greek is quickly changing against your position, will it cause you to exit a trade? It's all trade dependent, strategy dependent. It's a delta. You know, I may sell something at a 10 and decide that I'm going to exit it at 12 or 20, let's say at 25, just for an example. I sold this at a 10, I'll get out at a 25. And it's either an adjustment or an exit. When I say get out, that could be an adjustment, okay? I'm not going to get out because it moved from 10 to 16 instantaneously. It's happened. That's not where my discipline is. So along with the strategy and everything else, we have a discipline that we overlay on top of the strike and expiration selection, okay? And that's called trading discipline. And that will tell me what to do. Okay, gosh, here's another question. Illiquidity. Is that a reason not to trade a deep ITM? Because if price is in your favor and you gain explode, there's a chance that you may not be able to get out at a decent price. Okay, if it's deep in the money and it has very little parity, this is something you can always do, and it depends upon your clearing firm or brokerage house. A deep in the money call, you can always exercise and sell. There's something called a same day exercise. So you exercise it and sell it immediately. That is a way to get out. So deep in the money calls, deep in the money puts are hard to get out of. That is one reason why when I trade, I don't trade butterflies generally. I trade iron butterflies where I'm short to put vertical and short to call vertical because of the illiquidity of the in the money or deep in the money call on the butterfly. So those two strategies are mathematical equivalents. There's just a liquidity difference. So gosh, I'm not making real quick time here. 1.5 hours or half an hour, and I'm only 5 slides in. Okay. Oh, I'm 7 slides in. I lied. Let's go. Move on here, Frank. Covered calls. This is one thing, and this is an example, and this is one of the most common questions I get and have for years, and market makers ask each other is, okay, which month do you use? Now, typically, and this is something we teach a class on covered calls, but I'm not giving away any of our secret sauce here either, or the secret formula. Covered calls. The expiration month in most covered calls is typically the front month. And the front month in our case right now is February. Okay? And generally they trade an at the money, ATM is at the money, or an option that's one strike price out of the money. Okay, that's what people will trade, typically. Now, if you go on the internet, you're going to see people telling you that have systems that are 50 different ways. Okay, well, it's, you know, move at your own speed, do it small, learn, but gosh, there's so many variations of this. Okay. We talked about market sentiment, okay, and the strike price. Here's something on covered calls. If the market is trending up, we would sell an out of the money call, okay. If the market is trending down, I'll sell an in the money call, okay. that gives me more downside protection. Now, I'm going to show you, and gosh, what stock I use? I think I use Facebook, and we'll look at it. If I'm market neutral, it's like, hey, I think it's just going to stay here. The stock, I will sell an at the money call, okay? I'm figuring that, hey, I don't have much stock exposure to the upside or the downside, risk or reward, and the option price will go down. So here, and this is a case where I go, when I'm constructing a position, and this is something I have to force myself to do, it's what if, what if, what if. Now, quite frankly, when I did my Whirlpool trade last week, I did not ask enough what ifs. And that's what I mean when I go forensic audit. Hey, why did I blow up here? What did I do wrong? Well, this is going to be a simple what if. And right now in Facebook, I don't know what it's going to do in the short run. You know, let's see. But I'll go what if, what if, what if. Now, different people look at the risk analysis differently. I know people that just look at the math. Not Frank. I need a picture. So in this case here, somebody having problems with audio right now. Somebody just asked me. Okay. I hit something. I hit a mouse. And I thought it would say, okay, maybe I can turn up my volume. Ha! That button, the green phone, hangs up. Now, I would think the red phone hangs up. Okay, so this is what I'm going to call bullish. Okay, if you'll notice here, I'm long 100 Facebook, and I'm short a March 31st one call. Now, in OptionVue, it gives us the opportunity to look at the price here on the left, see where it says 50 to 50, or percentage. I look at this. It used to be that you could select it and you only got one or the other. Now, if you select rate of return, the percentage will be on the left. But I look at pictures. Now, you'll notice that up here, oh gosh, I'll get better at this, the sad little circle that I drew, okay? It says superimpose. This allows me to enter multiple trades, okay? So I sit here and I look at this, and this is how I look over price of the underlying, which is here, across the horizontal on the bottom, time, which is, here we have a dotted line, that's today, and this is going to be, oh gosh, March is, I would guess, 40 days from now or so. I should know that. I apologize for not knowing that. And I can select the number of time slices I want to put in, okay? I can also change implied volatility up or down on another chart over there. So let's see. Oh, I don't know how to do this. I was going to show you an option view. So I'll do that. This is bullish. I am selling and out of the money. And the question is, okay, fine. Let's look at the next alternative. This is what I call bearish. Now you could look at this and say, okay, I really can't tell. Because if you remember, the scale on what I did had 400 up here on the bullish one. Okay, so it's like, okay, fine, this is bearish. These are what ifs. What if 1? This is what if 2. What if 3? Okay, neutral. Okay, gosh, it goes up to 240 there. Well, the question is, which one do I think I want to do? Now, let's think about, and I would do, it's not the only tool I would use. I would look at the news on the stock if I had not traded Facebook before, if it was something I traded. On covered rights, it's always a good idea to know, go back to information. Know when dividends are, know when earnings are. I actually, this is something I actually buy right, and to be quite honest, I got out of Facebook before earnings last week. I mean, I think we all saw it go from 40 to 19. Oh, fine, I had some profit. There's no shame in taking a profit. I'll have people that will refuse to take a profit because they'll say, well, geez, I only made $60. I only made 2%. Well, sometimes making 2% or $60 is better than losing 100. I mean, it's just one of those things. Do not be afraid to take losses or profits. Taking losses is the hardest thing you can do. So here, we have all these. Remember I showed you, there we go, superimpose. Okay, I superimposed. Okay, well, depending on one's sentiment, okay, and how worried they are about the market. Okay, we're looking at this at probably, it was around 28. I did this today. I have no idea where Facebook is now because I haven't been talking to you. But yeah, it's about the same place. It's 28.30. So, am I concerned to the downside? If I have no concern to the downside on the stock and I'm bullish to the upside, I'd probably take this top one right there. Okay? This is what I would want to trade. Okay? And so, that. Wow. Okay? And of course I didn't do this right. Well, I'm erasing all this because I'm not real good at this. Nope. Ha! Okay. Then we have our neutral one. A bit more protection to the downside. And this. Now, I, as a trader, I want to hit singles and doubles. I do better when I say, hey, I want to do something again and again and again. Now, this is a 26 call on the buy right. This is a 29 call on the buy right. This is the 31 call on the buy right, meaning I bought Facebook and sold. This is a graphic representation of what the risk graph looks like if I sold a 26, 29, or 31. Now looking at this, and the question becomes, what if, what if, what if? I'm thinking, what if I did a 27? Maybe I like something better that would be more like this. Okay? And I'll make a decision on a picture. Okay? For the way I learn, we all have different learning abilities and ways of looking at risk and reward. You can't do too many of these. And if you get more, and a buy right's about as simple of an option strategy as there is. A mistake that all of us make is we'll put on our positions and at any strike and say, and you can ask the person, why'd you put that on? It looked good. Something could look good, and the other 11 alternatives, different expiring months, would look better. And so, my advice is, what if, what if, what if, and we'll add a fourth. What if? Okay? So, any questions before I move on? Nope. Okay. Let's see what the next slide is. Liquidity. I'm going to show you some examples of what I mean by liquidity. And this is something that I quite often do. I have one student that trades very large amounts, and liquidity is the most important thing to him of all. Yes, this is recorded. I can see it recording. So, Larry, thanks for asking. I've been known to not push the record button. And okay, so there, I found this. Liquidity. This is the SPX. I guess it's 39 days to expiration, not 44. I guess I lack calendar integrity. But this is today's SPX from a couple hours ago, an hour and a half ago. One thing I want to mention to you is, look at this, the 1550 call. Everything that trades on the, I'm going to change colors now, and I use blue because they always talk about red ink, okay? And actually, we'll go down here and look at the volumes. And you will notice something when we start looking at things. Look at the open interest. 157, 82. You start going across, and what do we see? Where the major open interest is, it's a 75, a 0, a 25, a 50, a 0, 25, 50, 75. When I trade options, quite frankly, I trade iron condors, trade butterflies or whatever, I look to see where the interest is. So you could look at this and you say, wow, the 1550 is 50 cents wide, while the 1545 is 80 cents wide, okay? 1525, 70 cents wide, okay? But the option below it's 80 cents wide, and the option above it is 80 cents wide. This is a function, and I'll guarantee that the bid ask is actually narrower here. There's a lot more people interested in trading this than they are interested in trading the other options. Okay, but if you look here, this is $1.40 wide, $1.40 wide, $1.20 wide. Now, if we go to the 1375 put, see how that's narrower and more liquid than the, excuse me, I don't have anything there. But I guarantee, let's see, the 1450 puts, 80 cents wide. I would guess a 1450 call is around $2 wide. If you'll notice, there's not much of a trade here at all as we start going deeper in the money. So, vertical. Let's see if I can figure out how I can share my screen. Okay. I believe I hit share here. Presentation. Oh, I think somebody's telling me how to do this. Hey, Jeremy, are you online? Could you remind me how I share a screen here? Let's see. All windows, video, and text. Click the plus up next to the presentation. I got to put glasses on. Oh, I see it. There. Share my screen. Okay. here's a trade. Okay, I'm going to minimize this. Can people see OptionVue here? Okay, cool. I'm going to do Whirlpool. God, this you know, it helps to have a big dose of gotta wanna. You gotta to be a trader. You gotta wanna do the next right thing. You gotta wanna not lose money. Okay, you'll notice I haven't been trading these a whole lot, but here's earnings that I had put in a while back. If I have it memorized, quite often I don't look, but I'll look here, and so that's 1023 undeclared, 1025 undeclared. I trade mostly indexes. Okay, we'll find Whirlpool. Well, guess we won't. Edit, insert role. WHR. Okay, I am going to go back. Here, one thing I always do, and this is part of a trading discipline, I look at what's my model. I don't like to call put skew, true delta gamma, Yates, no slippage. I don't like to look at commissions because I put them in with my head. Bid ask divided by 2. I look at volatility, and I'm just double checking there. Settings. Okay. I'm going to check something real quick here. This is an exercise I go through all the time. Okay. I just unchecked this, and it's checked 50 asset files, and it removed it. Okay. So, clear trades. I'm going to go into one of the handiest things here is called Backtrader. Now I know I did this on Thursday at around noon. Okay, and I was bearish. Okay, so I bought let's see. 10 of these for $320. And when I say 10 of these, I mean 10 put verticals. I was bearish, okay, and there was enough of a volume there, okay. Analyze. I sat there, and quite frankly, I didn't look close enough. It didn't take much of a move up to lose $1,000. Okay? By the same token, I should have said, okay, what does this look like? Okay, which I never did. Analyze. Superimpose. This is far more tolerable. Okay? Up $2, I lose that much. Okay? Now, if I go today, okay, I'd still be in the trade, okay, and I would have done this trade for probably $1.40, okay, and actually, here's something I would have done, and this is a trader thing. I'll look at this and I'll go, hey, that's a midpoint. For an extra $5, I get another 2.5 points. Okay. For this one, if that's and that price doesn't look right, we'll move it half an hour. I would have moved here for an extra $10, okay? I would have moved this 5 strike, dollar risk reward by $500 of reward for a dime, or not a dime, 13 cents, $13, okay? What is that? 41 to 1, something like that. No, 39, I mean. 4 times 13 is 50, 520. So 39 and a half or so. But, I'm looking at that. So actually, 0. Oh, I'm selling that. So I'll sell this. Once again, I talk out loud to myself because all of a sudden, if I was buying this, and if I was doing a strategy where I sold this and bought this, I bought this. But since I'm selling it and can get 8 cents, no big hoo. Okay? So, because I don't want to limit my profits. We'll look at this position right now. Okay, I got out at about $2, $1.80. I'm only down $3.30. I ended up losing close to it. Or if I had looked at the risk reward and said, Frank, you want to hit singles and doubles, not home runs, I would have been much better off. Okay? But as we go through, so $380, that's within my loss goal because I'm bearish on this. I really don't like the stock. So we'll go to mid-morning on Friday. Okay, I'm only down 160. I'd still be in on this. Where are we at noon today on this stock? I have no idea. I would have been up $400. So we go through this. It was minus 380. This is an example of bad strike selection. Okay, guys? Pure and simple. That's a $1,400 swing because I didn't do the extra what if. Okay? Whirlpool. So right there, that would have been a nice one. And I wouldn't have lost it. And it seems so simple. And it is so simple, okay, to do this. So here, I'm going to move this over and sharing for a moment and see if anybody has, okay, let's see, presentation. Now, that was a real life example of an error that I made. And I have 25 years experience. I didn't ask quite enough what ifs. Now, one thing I can show you, and I'll go back to, is I was bearish on this in the short term. So one thing that I looked at, and I'm going to do this again. Okay, does anybody have a question? Okay, I'm going to show you something. And this is an example of how Greeks reduce things to the lowest common denominator. We're going to share a screen again. Okay? Okay, back to Whirlpool. I have volume here. We're going to look at delta, we'll look at Greeks. Movement in price. And how fast it moves, the price moves when we're going. So here, if you look here, I had a delta on this one of around 32.7. And that's what it was when it moved against me. This was about 70. So it moved twice as quickly against me when I was wrong. I was looking at the reward, not the risk. If I had been looking at the risk, I'd say, hey, I move that quickly, okay, against me. Another thing is how quickly this moves to my advantage as we go. Month selection, I thought it was going to happen in the short term. So we have something here called delta and gamma. The gamma is much higher as we go across on the front month. Now the delta's a little higher, but 1 point or 2 points, and that difference has been made up, and it's going to accelerate on the way down. So another thing that we could have added to our analyze, okay, would have been other months. Okay, what does this put vertical? The 110.95, the March 110.95. What does the June 110.95? What does the Sep 110.95 look like? And compare those. And we can make fairly rational decisions, very rational decisions, if we just go, what if, what if, what if? So the next step I was going to talk about, and I'll show you this, and I didn't do this here. Oh, come on, Frank. Pretty cool. I was going to talk about butterflies and how we can have a delta or a price move opinion. And that's by shifting your center, your two shorts, up or down, okay? So, but I didn't get to that today. So thanks a lot from the folks at Discover Options. I can take a few minutes here and ask any questions you might have, okay? Gosh, on your WHR trade, what were your bearish indicators and confirmation for a directional trade? I just watched WHR. And over time, what's important to me is my exit points, my stop, where I take exit from a loss standpoint. Am I going to adjust? If I'm going to adjust, how I'm going to adjust, and where I'm going to take my profit. So it was just based on experience. Okay. Where do we find the recording? Should be on the website. They'll send out an email with the link to the recording once they've gotten it done. Okay. Boy, some people tee stuff up here. Okay. Any other questions? Okay, well, this was fun. I enjoyed it. Tune in next week, and one of the other mentors, Paul, Ken, or Steve, will be there, okay? They always post, it's always, for those of you that have Facebook, please look for OptionVue Systems on Facebook. It's always posted there. In addition, the blog entries, I do a Monday morning, actually a Sunday afternoon blog with all the economic announcements for the week and their times, and all the optionable earnings announcements, and with a volume greater than 200. There is your liquidity. Implied volatility greater than 20. There's your implied volatility, and a price greater than 20. Okay? Oh, Bill, somebody just said you don't need to be a Facebook member to see the OptionVue Systems page on Facebook and view the recordings. That's awesome. Well, I had no idea. Okay, thank you very much. Have a great day.